back to this episode of Artwise. We're discussing art funds today, something which has been a bit of a controversial subject sometimes, but we're going to try to get the real picture today. Let's get our first question to Mr. Ajay Seth. You're someone who's had a good success rate in handling your fund, Copal Art. How did you manage through the years of 2008 and 2009?
During these two periods when the boom was there, people invested with us, they got the paintings, they saw the deliverance. What they liked about this was when the market crashed, they thought art is one asset class where their money is safe. Because even during this downtrend which had happened, all the artists which we had recommended to all our clients had performed exceedingly well during that time. And from that time we have not looked back, and people have been putting repeat portfolios with us. I think one was the hand-holding, the thorough research, and our own strong conviction in the art bank or the artists which we were recommending out of the portfolio.
So you're saying it's probably recession-proof and inflation-proof?
Absolutely. Absolutely. I mean, it's the history which you could see so far as Copal is concerned.
Fair point. On that note, in fact, we were just playing out for you a few minutes back in the previous segment, the history of art funds. Let's also clear another package that will tell you about the lessons learned from the crisis period, the investor education, and how exactly Indian funds can be put on par with Western art funds.
Historically, art has outperformed equities and commodities and even different alternate assets. It is seen as a hedge against inflation and a bulwark against volatile equity markets. But following the debacle during the global financial meltdown, there is clearly a need for stronger and resilient products tailored for an emerging art market in an emerging country. India needs to borrow the best of global systems, processes and checks to inspire confidence among art investors.
We have about 100 investors worldwide in the Fine Art Fund Group, who many of them 16 are billionaires. They're from 16 countries, many of them worth hundreds of millions. They invest 1 to 5% of their portfolio into art. We have specific rules. We have a sort of 100-page document that sets out the rules of everything we do in order to avoid conflicts of interest, to get investor confidence into investing in art through a fund or through a management team like us. They need to see that the same type of controls that you would see in Carlyle or KKR or Permira or some of the big private equity houses exist in the Fine Art Fund, and we set those standards up.
Investing in art requires the passion of an art connoisseur and the expertise of a market analyst, where you don't just appreciate what you buy, but are also able to assess its value in terms of returns and risks. Art funds must function in exactly the same way, donning the dual role of fund managers and art experts in order to offer enduring value proposition to investors. A case in point being Copal Art Fund that succeeded where most other funds failed to stay afloat.
Alright, I'm going to quote an Ernst & Young study that was done on the art market and art funds. It says that the emergence of art funds brought in new investments of about rupees 220 crores. Mr. Bandyopadhyay, does that surprise you to hear that figure?
Not really. In fact, if you look at the international experience, art is one component of the alternate assets as a wealth manager or as an advisor. Normally, we would like to recommend an individual to keep at least about 10% of his or her assets in alternate classes of assets, which is away from the traditional like equities, commodities, and things like that. So, in that alternate asset bracket, art features prominently. Of course, there are other luxury items, but art features prominently. And with the wealth of Indians going up post the liberalization and the market reforms, we also have seen and we find that there is a clear need and emergence of investing in art.
Mr. Kanga, a question perhaps on approaching investing as such. How much of your investments should you keep aside for art, and within that, how much should be used, say, towards a directed art fund vis-a-vis buying art directly? And some thoughts on what kind of returns you could get?
Whether you buy art direct or you invest through Copal, it's going to be the same thing, because you're going to get the art piece and you're going to keep it with you. the advantage of investing through Copal is that you get guided, that these are the artists that are, that are appreciating, these are the artists that you should buy, upcoming artists, these are the ones that will go up. And I invest something like 5% of my investment portfolio in art. And as far as returns go, I've not really actually ever sold a painting, so I don't know what the returns will be. But I would think if you're getting 15% per annum, 15 to 20% per annum appreciation, that should be a good investment in art.
Just taking a point that Mr. Kanga made, is 15% a good enough return to be investing in art funds? I mean, when you have inflation being where it is, you have the options of equity markets or money markets or commodities. Is this a good investment to be considering? Because as you rightly pointed out as well, there is the illiquidity and, as Ajay was saying, the lack of transparency part of it as well.
Rahul, I think there are two things one needs to understand here. When you're investing in art, you're actually, I would expect the person to be loving art also, and he's enjoying the art. So I think mostly investors historically have been investing in art because they like art, they enjoy art. Yes, of course, there is an objective of making money and a good return. So that also happens. And Mr. Kanga, as he rightly said, he has never sold. So probably he's not the right person to ask what kind of return he wants or he has achieved. But I can tell you from historical experience, the returns have been phenomenal. So I think 15% is very, very conservative. The return can be much, much more.
Mr. Sahar, I'm going to ask you a question on a different note now, related to art funds, of course. We know that the SEBI regulation came in late in 2007 or early 2008. How did Copal manage to not come under that bracket? Because a lot of art funds really got affected by that.
See, as you said that SEBI directive was basically towards art funds.
Right.
And these were collective investment schemes. So in case of Copal, it is an individual buying. So it's covered under Sales of Goods Act. So it's an individual who's buying a work of his choice or a recommendation. Either rather than buying from a gallery, he's buying through Copal. So it was not a collective investment scheme. We were not pooling money from the customers or the clients. So that's the reason.
Fair point. Let's take another break on that note. More on art funds when we come back in just a couple of minutes. Stay tuned.
Don't go away. Welcome back to this special episode of Artwise, where we're discussing art funds. Mr. Imtiaz Kanga, one final note from you on this. Were you ever nervous when you put in your money for the Copal Art Fund at any point of time, especially 2009?
Not really. I checked with people about Copal. I talked to Mr. Ajay Seth. I talked to him for about a year before I put in the money. So I think I've made a wise investment.
That's a reasonable endorsement for Copal as well. Ajay, since Sahar brought up SEBI in the previous segment, there's been a lot of apprehension in the change in costing structure and the way SEBI has been viewing mutual funds. There's been a sort of tactical shift in the industry as such. Can you share for the benefit of our viewers who are looking at perhaps investing through art funds like yourself and others, is there a costing structure that they need to be aware of when they're considering an art fund?
See, I think, I would say that I'm not the best person to talk about the art funds because we are trying to create new collectors. I suggest only one thing, that there is wealth creation through aesthetic pleasure. So one should think of owning artworks and good artworks. Now, see, the benchmarks on the what we call as return ratios, what are the managers' fees and all that, this market, Indian art market, is not yet fully matured. Like the ratios which we are talking about, the profit sharing, the taxation, because it is this market, once it settles down, then we would basically know what is the cost of the managers to the fund. The best way is to own a work of art, and as and when you feel that you want to swap or you want to, if at all, like you want to sell, you sell it. So with Copal, you save on the gallery cost.
Right.
With the auction houses, you save buyer's premium. So you're in a win-win situation.
Mr. Bandapalji, on a final note, how are you expecting art funds to perform now?
Well, I'm a bit skeptical as far as the art funds are concerned because, it's like a black box. The same reason I explained that I don't trust real estate mutual funds. So, if you're investing in an illiquid asset which is high value, probably the fund structure is not the right thing to go ahead with. You should buy the art, you should own art, enjoy art, and when you want to get rid of it, when you want to sell it, you do sell it.
I guess let's thank all our guests on that note on this discussion of art funds. And if you have joined us, on behalf of the entire team, thank you so much for watching. Goodbye.
Thanks for watching.
Brought to you by Copal, the world's biggest delivery-linked art fund. A Bloomberg UTV Pulse initiative.